Why debit spreads beat simple long options positions. Before we explore why debit spreads beat simple long options positions, by way of preamble, let's spend a few moments explaining what a debit spread is, for anyone new to options trading. Debit spreads are an option strategy which have been given this name for a number of reasons. Firstly, because to create them, a debit is applied to your brokerage account. They are called spreads, because they comprise a combination of long and short, that is, bought and sold, options positions, with different strike prices. The difference in these option strike prices is called the spread. Option spreads have two or more strike prices in them. Each single position is usually called a leg. Debit spreads are also called vertical spreads. A vertical spread consists of an equal number of long and short positions, but with different strike prices. To be a debit spread, the bought leg of the spread must be closer to the current market price of the underlying stock than the sold leg. Putting it another way, the long position is closer to the money than the short position. The short leg of this strategy will realize a credit to your brokerage account, which will offset the cost of the bought or long options that you have purchased. The overall effect will be a debit, hence the name, debit spread. Vertical debit spreads involving call options are known as bull call spreads, while those involving put options are bear put spreads. Okay, so now that we are clear about what a debit spread is, let's examine debit spreads, risk, reward, and strategy. Unlike simple long option positions, where your potential profit is theoretically unlimited, vertical spreads have limited profit potential, but we aim to demonstrate that they also involve less risk, and managing risk is the key to successfully trading the financial markets. The maximum profit is the difference between the strike prices less the initial debit. But there are some serious advantages with debit spreads over simple long options. 1. You lower your overall risk, because the short position will offset the long one. 2. You control the same number of underlying shares, but for a less cost. 3. You reduce your exposure to options time decay. 4. You can give yourself more time to be right, without it costing a lot more. 5. Sometimes, the implied volatility component of options pricing can work in your favor. Before you enter a debit spread, your policy should be to pay not more than 50% of the difference between the long and short strike prices. So if you're doing a $5 spread, you should pay no more than $2.50 for it. For a $2.50 spread, no more than $1.25. And so forth. In other words, you would like to see at least 100% profit potential before entering the trade. Your $2.50 should have the potential at option expiration date to return $5 profit and so on. Here's an example. ExxonMobil is currently trading at $80 per share. Your analysis leads you to believe that its future price direction will improve to an estimated $87, so you decide to enter a bull call debit spread by buying $80 call options and selling the same number of $85 call options, thus creating a $5 spread. Looking at our option chain, we can see that to buy an $80 call will cost $2.05, while the out-of-the-money $85 calls can be sold for 45 cents. Having offset one against the other, we realize that we can create our debit spread for a net cost of $1.60, with 74 days to expiration. You'll note that the cost of this spread, compared to the difference in strike prices, is less than half, $1.60 being much lower than half the $5 difference, so it's a good deal. If, between now and expiration date, the share price advances upwards, your $80 long call option will increase in value. And the deeper in the money it goes, the delta component in the options pricing formula will also increase, so that the option price will eventually move at close to a 1-to-1 relationship with the underlying share price. Meanwhile, the out-of-the-money short-sold option price will also increase, but at a much slower rate, since its delta is much lower. And until it hits at the money status, its only real value is time value, which is the calculated probability that it will be in the money at expiration date. So the difference in the rate at which the two option prices respond to upward movements in the underlying stock price is where your debit spread makes an overall profit. If you let it run until expiration date, and the stock price is above $85, you make 313% profit on the trade, being the $5 spread, divided by the $1.60 cost, times 100. If you had only purchased the $80 calls for $2.05, then, at $85 share price, you would still make 244% profit, at expiration, being $5 divided by $2.05, but 313%, using the debit spread, is much better. If the price had gone to $87.50, then you'd make 366% profit on the single option, but as we can see, you need the underlying share price to move upwards by another $2.50, for only slightly more profit, and why should you risk that? Now let's look at debit spreads, money management and averaging. Profiting from option trading involves the important issue of money management. It's all about risk and reward, the amount of your overall capital that you risk, versus the potential reward on each trade. The preferable result is for the underlying financial instrument to move in your anticipated direction, and you take a profit. But what if price action goes against you? Debit spreads cost much less than simple long positions, so if the underlying price action goes against you, and you have factored in more than 100% potential profit on each trade, and your strategy is to hold your positions until expiration date, then one possibility is to consider averaging up, if it's a put spread, or averaging down, for call debit spreads, as a way of potentially realizing an overall profit. Bearing in mind that debit spreads reduce the effect of option time decay, so that you can choose later expiration months, for much less cost than buying single options, and knowing that your maximum loss is 100% on the cost of any one trade, you can use the profit from your second trade, to offset any losses from the first one. So if for example, you made 313% profit on your second trade, on the same underlying stock, but lost up to 100% on your initial trade, then your overall average profit is still 213%, assuming that the capital risked on each trade was the same. You could use Fibonacci extension levels to determine your second entry point. Here's an alternative strategy. If the price action goes against you, then you can also consider buying back your original short position. As it goes further out of the money, the short leg of the debit spread becomes much cheaper. Eventually, you can buy it back for pennies, making a theoretical profit on the short side. If the stock price then pulls back to somewhere close to where you entered the original debit spread, then you might be able to sell the remaining long leg, for a similar price to what you bought it for. The profit on your closed short position becomes your overall profit, or at least, will offset any loss on the long leg of the spread. Sometimes you can make a great overall profit this way. Combine this strategy with averaging and you increase your likelihood of success even further. Thank you for watching. Please like and subscribe for more videos like this.